and that everybody can see my screen. Please let me know if I need to increase my volume. Good evening, everybody.
Brother.
Good evening, sir.
Good evening, we can hear you.
All right, good. All right, today we're going to continue our business. Last week, we began to look at transactions that may take place between owners. We said we could have a situation where, you could have piecemeal acquisition. First of all, we started from piecemeal acquisition. That was what we faced last week. And we said there are basically three forms of piecemeal acquisition you may have. We said an entity could move from being an associate, meaning that they have equity interest between a level that is higher than 20%, but less than 50%. To put that in better context, you're saying you have equals to 20 or greater than 20%, but not greater than about 49% shareholdings. In this case, we said that company will be referred to as associate. Now, as an associate, they may now buy more equity interest or shares in the subsidiary to a level where they now have controlling interest, meaning that they have now crossed the 50% mark. Immediately they cross the 50% mark, we said you are going to switch from equity method to consolidation. You will now fully consolidate all the affairs of the group. It will be the responsibility of that company, who is now a parent, to publish a consolidated financial statement. We said we can have that case, moving from associate to parent. We also said that it could be a simple investment, meaning that the investment was previously less than 20%. That's a simple investment. It's just meant for accretion. However, if that company now acquire more shares to a tune where they have now crossed the 50% mark, then you are going to move from whatever method they have chosen under IFRS 9, you are going to move into the rules of business combination IFRS 3, and the implication of that is that you're going to use IFRS 10 principles in consolidating the affairs of the entire group. It becomes the responsibility of that company, who is now the parent, to report the consolidated financial statement. All right. Now, we also now said, which was the last thing we discussed in the last class, that we could have a situation where a parent company, meaning that company already has controlling interest, say they had 70% holding, they may now decide to go ahead and even acquire more shares. Let's say, for instance, they bought 10% additional shares. The implication is that they have gone from 70% to 80%. Now, this does not mean that they are now having control. They already had control. They only have bought more shares. We said this type of transaction will be referred to as a transaction between the owners of the subsidiary. Now, the implication is simple. It only means that if the parent has gotten 10% additional shares, then NCI, non-controlling interest, have lost 10% holdings, right? So NCI would have gone from 30% in this case. Let me annotate so that you can follow very well. We said parent went from 70% to 80%. Sorry. To 80%, meaning they got 10% shares more. We said by implication here, NCI was 30%. Here, NCI would have lost 10%. And what you are going to have now is NCI is now 20%. We said what you're going to do in this case is you're just going to recognize, is there any gains or loss upon this transaction? And you will make an adjustment straight up in your profit or loss, consolidated profit or loss. However, because you might be dealing with financial position, like we have always said, when you are dealing with financial position, the representation of P or L on your financial position is retained earnings. So it should go to your consolidated retained earnings. Let's try and do a refresher on that before I move forward. Before I move forward, let's do a refresher on that just to remind us what we said last. Okay, let me look for it. I think it was the last thing. Okay, yeah, good. Increase in controlling interest. Just pay attention to problem 6.4. It was the last thing we discussed, or the last thing we solved in that class. They said the facts are the same as in question 1, which we solved last week. And I said, show the consolidated current assets, non-controlling interest, and reserve figure if Mammon acquired additional 10% interest in Regis on 31st December 2016 for 700,000 naira. Okay, now bear in mind, how do we go about this treatment? We said, according to the note, the adjustment to parent equity is that you consider the fair value of the consideration that was paid, and then you compare that to the decrease in NCI net assets as of the day of the transaction. Recall that the question would have made mention to you, what is the group policy in measurement of NCI? You could have been told it is proportionate share. If they told you it is proportionate share, it simply means that as of that day, I am going to calculate what the decrease is in terms of, if it is 10%, then I'll do 10% of the net assets, of the net assets of the subsidiary as of that day. But if I was told that it is fair value, either the examiner has given me a fair value, or they are going to tell me what is the market value of the shares of the subsidiary, and I will use that in calculating what is the equivalent amount for the 10% shares. I mean, first of all, do the number of shares representing the 10%, then multiply by the market price of the shares. Let's look at this question before we move on to what we have for today. So in this regard, we said 700,000, right? That was the consideration that was paid. If 700,000 was paid for 10%, so what really is the 10%? What really is the 10%? Remember that we had calculated NCI in that question to be 2414. So what we did here was to say, if 2414 represents 40%, and now we have lost 10% of that, we can as well just say the 10% we have lost is 10% out of 40%, representing this. And that's how they got 603.50. So the simple double entry for this, is first of all, the simplest thing I know. I would have transferred money as a parent. I would have transferred 700,000 away from the bank, isn't it? We would have done that, right? And then now what I paid for is 700,000, but I mean what I paid for is what 603,500. So I had to pay higher than that to acquire it. So it means I have made a loss, right? What I acquired is what 603.5, but what I paid is 700,000. Okay. So therefore, my P or L or consolidated retained earnings will take the difference, which is 96,500. However, this what will leave NCI. This much will leave NCI. Now, remember, I always tell you, the reason I always say that is because it is easy. Why I always talk about NCI being an equity is that it is easy for you to get carried away and take it as an asset, because you say NCI is investment are assets before you know. But in the group account or in the consolidated financial statement, we have said it, according to IFRS 3, NCI should show separately as a component of equity. So if I'm thinking that way, that NCI is equity, then I will know that a reduction in NCI should be a debit. So NCI should be debited by how much? 603,500. This is the simple double entry. Now, they said we should show how it is going to affect current assets, right? So how does it affect current asset? Bank is a current asset. So you are going to reduce current assets by 700,000. It's as simple as that. NCI is going to reduce by 603,500. However, your consolidated retained earnings will only reduce by 96,500. So it's as easy as that. That is all the adjustments that I would have to do. However, we have not lost control. Because we have not lost control, I will continue to consolidate. I mean, because we are still in control, we have only acquired more shares. I will continue to consolidate. All right. Do we have any question regarding this before I move further? Do we have any questions? Do we have any questions? You can use the chat box or you can unmute. You are allowed to unmute should you have any questions at all. Should I move on? This is clear, right? Mercy, is this clear? Can I move on?
Yes.
All right, good. So now we go into what if it is not a case where we have been talking about acquisitions. Today we are going to be looking at disposals. We'll be looking at disposals. How about a case where there is no acquisition? Acquisition increases the position of the parent. How about we have a transaction between owners whereby the parent disposed assets, disposed equity. Whereby the parent company has sold all of its equity interest in the subsidiary. All right. We may also have a situation where a parent only disposed to the level where it became an associate. It disposed to the level where it became an associate, meaning that, like what has been used as the example here, you have a case where the parent company sold 30%. They disposed 30%, and they initially had 75%. So when you do 75% minus the 30% that is sold, what you have minus the 30%, what you have is 45%. All right. So this 45% no longer qualifies to be called, no longer qualifies for controlling interest. However, it is now between the 20% to 49.99% mark, meaning that I will now refer to it as an associate. All right. I will now refer to it as an associate relationship or investment. Now, we could also have gone from being a parent to only retaining simple investment. We said anything called simple investment is less than 20%. Less than 20%. Okay. All right. So we could also have a case whereby we have not lost control. We disposed. However, we have not lost control. Perhaps we had 80% and then we sold off about 20% of what we had, meaning that what we have left is 60%. Since 60% is still higher than the 50% mark, we will continue to consolidate. All right. So you see, all of these possible scenarios can be grouped into two. It can be grouped into two. How do we group them? Very simple. It's either we have disposed of to a level where we no longer have controlling interest, or we have disposed of to a level where we have retained controlling interest. Okay? Where we have disposed of and we have controlling interest, or we dispose to an extent where we do not have, or we no longer have, controlling interest. All right? Now, when we disposed and we still hold equity interest, it means we have some level of equity interest that is still retained in the subsidiary. All right. We may no longer have controlling interest, but we may still have, like the case here where we went from controlling to subsidiary. Of these are possible option. All right. Somebody said my line is breaking. Can you hear me better now?
It is.
How about now? Is it better? That's what I'm trying to know now. Are we better now, or my line is still breaking?
I think it's better now.
Is my okay. Okay. All right. All right, okay, let's move on. So in all of these explanations, what you should be asking yourself is, so what do I do when I am confronted with this? What are the adjustments that I am supposed to make? All right. I will ask you, I'll beg you, plead with you to be very focused in this class. Very, very focused so that we can treat this block by block and then we can achieve the understanding of what is expected of us. It can be a little bit tricky, but I can assure you it is not complex. We're going to start with rather very simple assumptions and then graduate into a question that has a little bit more complexity. All of it is in the notes. We'll take it up from there. Now, I just want you to pay attention to what was said here. The first three situations we had here, if you look at it, whether it's full disposal, whether it's subsidiary to associate, or subsidiary to simple investment, what happened? Control was lost. However, when you look at the fourth scenario, subsidiary to subsidiary investment, where we are 75% holding, and then we disposed 15%. What happened there? We have only decreased our holding from 75% to 60%. 60% still means that we still have controlling investment. In this type of situation, control is retained. All right? Now, let's look at some adjustments, okay? Where control is lost, there are two gains on disposal that we are going to talk about. Sorry, where control is lost, we are going to look at it from two perspectives. From the group perspective, and then from the perspective of the parent that has just lost control. We are going to calculate the gain or loss on disposal. And how do we do that? We simply say, what is the fair value of what the parent company has received? Of course, they disposed, they would have received a consideration for the interest, equity interest that they have just disposed, okay? If there is any investment retained, when we say any investment retained, we are saying, do we have investment to the tune where we are still an associate? Do we have investment to the tune where we have a simple investment? Or have we lost it so that there is nothing that is retained? What we will have as retained investment will be simply equals to 0. Now, pay attention to this. We are going to compare this value. This is the value we have received. This is the value we have retained, all right? Whatever this accounts for, let's say it accounts for 80% holding, all right? This 80%, we are going to look at it against what is the net asset and what is the goodwill. I'm sure you know that this is 100%, all right? Then we'll now ask ourselves, if we take away the non-controlling interest, that is 20%, what we are going to have here will be the 80% as net asset. Net asset of the 80% that we have disposed and the fair value consideration that we have received plus anything we have retained. That is going to tell us from the group perspective what is the group gain or loss on disposal. It's going to be better understood with demonstration. We're still going to get there. However, in the separate book of the parent, before I move to the separate book of the parent, emphasis was laid here. If this value here is greater than this, then what we have received is higher than the net asset that we have sold. Therefore, we have made a gain on disposal. However, if it is the other way around, what we have received is a lesser amount compared to the net assets that we have disposed. In this situation, or in this case, we have made a loss on disposal. And that will reflect quickly in the consolidated retained earnings. All right. However, in the separate book of the parents, how are they going to calculate their gain or loss? It's simple. We are simply going to say, what is our investment? What is the fair value? What is the fair value we have received for this investment we sold? Fair value of the consideration. In this separate book, I am not considering anything that has to do with NCI. All I'm going to say is, what is the fair value of the amount consideration I received? Compare that with the carrying value of the investment that I have sold or disposed. The difference between this will tell me whether I've made a profit or loss. And that profit or loss immediately goes into the profit or loss and statement of profit or loss of the parent in their separate financial statement. Okay, I'm going to take this in a question. We'll look at a question so that we can gain better understanding of what has been told us there. Okay, now what if you have a situation where control is retained? If control is still retained, okay, we have only sold off maybe 20% out of the 80% that we owed, meaning we still have 60% left. In such a situation, what has only happened is that NCI has increased. This is similar to the situation with when a parent company buys additional shares. It's just a transaction between owners, where what has only happened is that NCI would have decreased in that situation, while parent company equity will increase. In this situation too, where control is retained, parent company disposed part of their investment. They disposed part of it, but they have not disposed to a point where they have now lost control. They still retain control. So what will just happen is the equity holdings of the parent will reduce, while the equity holdings of the NCI will increase. It will increase, but they will still be a non-controlling interest. It is the parent company who will continue to have the responsibility to consolidate, report in consolidated financials, right? Now, we said if control is retained, all you need to do is to, almost like the same thing we did the other time. The other time we said FV of consideration paid, Abi? And we deducted that from decrease in NCI. We are doing the same thing here. What is the consideration received? The opposite. And what is the increase in NCI? Deduct that, and that adjustment, that profit or loss, that gain or loss is going to be adjusted in the consolidated retained earnings. I think we'll start with this one. It's a much simpler case. It was a much simpler case to handle. And it will be the first one we are going to handle. Let's look at problem one. Let's look at problem one. Are we together? Let's look at problem one together. Okay. We're told CACCO acquired all the voting share capital of RiceCo since incorporation of RiceCo on 1st January 2015 for 80,000 naira. The statement of financial position of Kako and Rice Co at 31st December 2017 as follows. Okay, if you look even into the statement of financial position they have given you, the first line you see there is investment in Rice Co. That's 80,000 naira that was mentioned. Okay, so it must have been in the books of Kako since January 1st, 2015. As stated in the question. Away from that, we move to the next paragraph. We're told it is the group's policy to value the non-controlling interest at its proportionate share of the fair value of the subsidiaries' identifiable net assets. Okay, on 31st December 2017, Kako sold 30% of its shareholding in Rice Co for 140,000 naira, required to prepare the separate and consolidated statement of financial position of Kako at 31st December 2017. Okay, first thing to do, lose controlling interest. Okay, the first thing is, what was their position before? Their position before was that they owned or they acquired all of the voting share capital of Rice Co since the incorporation of Rice Co, meaning that they used to own 100%. They used to own 100%, but now they have sold 30%. Now that they have sold 30%, they are going to be left only with 70% because they sold 30%. Okay? All right. So first thing first, you must ask yourself, now that they sold 30%, what did they receive for this 30%? They received only 140,000 naira. That is what they received for that 30%. 140,000 naira. In their separate book, I'm saying in the books of Kako, what they will do is this. They will say, okay, fair value of consideration that they received. How much? 140,000 naira. Okay. As of this day, what is the carrying value of the investment in Rice Co that we have just discussed? The carrying value in the books of Kako is 80,000 naira, but they have only sold 30% of it. If they have sold 30% of it, that 30% would amount to 24,000. Therefore, what they are going to have left is 416,000. This 416,000 is a gain on disposal. How did I know? What we received is greater than the carrying value or the carrying amount of the investment that we have just disposed. So therefore, in their own books, in their separate book, we have an investment that is supposed to reduce. An investment is an asset. If it's going to reduce, it means we are going to credit it. Abi, we'll simply credit 24,000 naira investment in Rice Co. Abi, we'll say investment in Rice Co. Credits. How much? 24,000. Okay. What else are we going to credit? We have made a gain. All right. This is going to P&L. Gain on disposal. How much? 116,000. Now we received cash. This one is going to the bank straight. We have received how much? 140,000 naira. Is this clear? Is this clear? This is what all that is going to happen in the separate book. What did you say?
It's not clear. Your line keeps breaking. I don't know if I'm the only one that has the challenge. I can't determine how you got the 24,000.
Okay. All right. I'll go over it again. I said they received 140,000 for 30% that they disposed. Abi? So if I want to calculate their gain, I must compare what they received for this 30,000 and then versus what is the 30% of their investment in rice school. Investment in rice school in their books is 80,000 naira. That is the carrying amount. Abi? But that carrying amount is a representation of all that they invested in rice school. But somebody has come now to pay for 30% of that, meaning that I will calculate 30% of the 80,000 carrying amount. Now that 30% of this 80,000 is what gave us 24,000. All right? So I'm going to compare what they received for 30%, 140,000. 30%, what is the equivalent of 20%? 30% as our book value. It is what? 24,000. That is the carrying amount. The 30% equivalent is 24,000. If I compare what we received to what we are going to have to take out from our investment, 24,000, I have a gain on disposal of 160,000. I now say the double entry is simple. I'm simply going to say bank, I received 140,000. Bank is an asset. When assets increase, you debit. So I say debit bank 140,000 naira. However, investment in rice school is also an asset. And now that one is supposed to reduce. It's supposed to reduce by 24,000. So I will credit that asset, investment in rice school, 24,000 naira. Now I have made a gain. I have made an income, a gain. So I will credit that gain to P&L or to consolidated, or to retained earnings. And that will be gain on disposal, 160,000. Is it clear now?
Yes, it's clear. Thank you.
All right. So recall that I said this is what is going to happen where? In the separate book of CACO. In the separate book of CACO, they will not consider NCI at all. Now let's look at how this will be treated in the group account. Remember, control was retained. Now, let's pay attention to the notes. They just said a few things here. They said, in this question, it specifically stated that CACO acquired all, meaning they had 100%. CACO has 100% holding in rice school at the date of acquisition. Next paragraph now told us that there was a turn on event when 31st December 2017, where CACO sold 30% of its shareholding. And now that means that they now have 70%. In this scenario, the first thing you must ask yourself, did they retain control or did they dispose of control? They disposed equity interest, but they didn't dispose of their control. Control is not lost, okay? So when this is the case, what do? You have to remember when a disposal of equity results in an entity still having a subsidiary investment, The only necessary adjustment is adjustment to parent equity. Okay, what we have just solved is what you saw there. Now let's come to adjustment to, you see, the first parent, the first adjustment we solved is this one. The next one is, how is it going to affect your consolidated statement? Very easy. This is the fair value of what we received. And it only represents 30%. Okay? Now, we are going to compare this against the increase in NCI. This is what NCI paid us for this increase. But what is the value of NCI? The value of the increase in NCI, what does it refer to? How much does it amount to? I always say, whenever you are dealing with NCI, you must always go back to the question, what did they tell me about NCI? Did they tell me NCI is measured at proportionate share or measured at full or fair value? The question categorically told us that NCI is measured at proportionate share. If that is the case, I need to first of all calculate what is the net asset. What is the net asset of the subsidiary as of the day of that transaction? Okay, as of the day of that transaction, which was, according to the question, December 31st, 2017. All right. As of that day, sorry, let me clear these markers off. As of that day, we're told that share capital was 80,000 naira and retained earnings was 120,000 naira. So therefore, the book value of what NCI has bought now, because we are dealing with proportionate share, will simply be the addition of these two, 200,000, multiplied by that 30%. And that will give you 60,000. So what are we doing now? We are simply comparing the 140,000 against this 60,000. And this is going to be the gain on disposal in the consolidated statement. Is this clear? Is this clear?
No, sir.
What did you say?
It's not clear, the last part.
Okay. So this is what I'm saying. From the perspective of the group, you see, we did not have NCI before. But what we are saying is this. In this transaction, we now have NCI growing from 0 to 30%. What is the consideration the parent has received? 140,000 naira, all right? Now, but when we are looking at the net assets, because they said they measure NCI at proportionate share. When we are looking at the NCI, when we are looking at the subsidiary rather, what portion of that subsidiary net asset will now go to the NCI? What is the value of what is going to go to NCI? You will calculate that by, first of all, totaling what is your net asset acquired. I mean, net asset of the subsidiary as of the day of the transaction. And then you say, what is the holding that NCI is coming to take? They are coming to take 30% of it. So 30% multiplied by the net asset of the subsidiary as at the date of the transaction. Now, you are now comparing like for like. The 30% that the parent, the amount that the parents receive for that 30% minus what is the equivalent of that 30% that NCI has just purchased. Do you understand now? So you are doing like for like. The 140,000 only represents 30%. Abi? That was disposed by the parents. The increase in NCI is also 30%. And we are doing 30% times the net asset. What did they give us? Okay, so the amount that has been received by the parent minus the equivalent of that 30% that NCI has just bought. The difference between them will now be the gain on disposal from the perspective of the group. So I ask again, is it clear now?
Yes, sir.
All right, thank you. Now you see, once you have dealt with this, you can now go on and consider the consolidated retained earnings. Now, in considering the consolidated retained earnings, you ask yourself, we already know this principle. What a parent has share in is post-acquisition retained earnings. However, we have made a very simple assumption in this question. According to the question, the parent has owned Rice Co. So when I'm going to start my solution, I'll say, okay, my retained earnings for the group, Abi. We are looking at CAC Co. And we are looking at Rice Co. As of, sorry, please. Okay. As of 31st, 12/2017. CAC Co has
Sorry, it's sounding as if you're far away. Yeah, it's sounding as if you're far away from the mic. Yeah, it's breaking.
Yeah. How about now?
Yeah, it's okay now.
We can hear you now.
Okay, good. So as of that day, as of the last day, the financial position you were given in the question, CAC Co has 280,000 naira, Rice Co has 120,000 naira. Now, don't forget that it is this same day that CAC Co sold to NCI. So therefore, all of this 120,000 naira belongs to CAC Co. I don't know if that is clear enough. All of this belongs to CAC Co. Group share will be 100%. CAC Co has always owned 100%. On 31st December 2017 was the day they sold 30%. Now, as of that day, all the retained earnings, all the profits of Rice Co belongs to CAC Co. However, from that day forward, any profits they now generate will now be split 70 to 30. Is this clear? Is this clear?
Yes.
So therefore, I'm going to say, take away all of the 120,000 and bring it to group. Group will take 100%, 120,000. Now, group also had, the parent company had a gain on disposal of how much? 80,000 naira, which we just calculated now. Meaning that altogether, they have 480,000 that will be recognized as consolidated retained earnings. Now, we measured NCI at how much? 60,000 naira. You must also not forget that. NCI is what? 60,000 naira. How did we do that? We did that here. We said, what is the net asset that was acquired? Share capital was 80,000. Retained earnings was 120,000. This 200,000, 30% of it is 60,000. So that is your NCI. So all along, all along, CACO had been consolidating 100%, no NCI. But you see, from December 31st, 2017, now that they have disposed 30% of their holdings, NCI will now come into the consolidated financial position. All right, let's look at it. At the end of the day, what was done is this. One second, please. It's why when you are looking at the solution, we are simply saying, okay, let me come to the question. We are simply saying our investment in ESCO, in RISCO, in the separate book, will no longer show a book value of 80,000. It will now be 80,000 minus 24. I don't know if you recall the 24. That 24 is the 30% they have now sold. Or if you like, you can say they now have 70% of this 80,000 left. If you do 70% of 80,000, you still have 56,000. So CACO, 56,000. All right. All right. Now, RISCO. Sorry, I said RISCO. Group. They said I should do for the parents and for the group. Now, for the group, there is no investment in RISCO. Would have canceled that out. Current assets. Current assets. For CACO, don't forget that they received, I would say 500 plus. Don't forget that they received cash. How much did they receive? They received 140,000 naira. So their current assets will now be 500 plus 140. But don't also forget that I am consolidating. So if it is now worth 640, for group, it will be this 640 plus the current asset of RISCO, which will now make it 890,000. We close off our assets. 890, 696, I guess. All right. Then when I come to equity, ordinary share capital, don't forget that we are consolidating. And in consolidating, it is the ordinary share capital of the parent that comes in, right? As for retained earnings, I need not disturb myself. For group, it's easy. I've solved it already. We got 480,000, isn't it? We got 480,000. But for CACO, it's also easy. They used to have 280 before. They used to have 280 in their books before. But now, don't forget that there is a gain on disposal. I said in their separate book, they would have done 140 minus 24. And that would have given them 116,000. So I would say 280 plus 116,000. And that should give me 396,000. All right. This will be 596. And this will be 680. Then there is NCI. NCI is not at the level of the separate book of CACO, but from the consolidated financial position, we calculated NCI It will be 30% of this. 200,000 times 30%, we said it was 60,000. All right, meaning that equity here will finish as 596. Here it will finish as 740. All right. In the separate book, current liability is 100. This will finish as 696. Abi? 696. However, for group, we are going to add this 150. 150. If you add that together, you get 890. So it's that easy. But we have made some simple assumptions here. When we get to problem, there's a problem we're going to solve where, first of all, the parent company will not own 100% before. Secondly, you are going to have to deal with pre-acquisition retained earnings. Thirdly, you may need to have, first of all, calculated goodwill at acquisition. All of this will come into the mix when we get to that level. But at this level, I just want to find out, first of all, do we understand what we have done here? Is it clear? Is it understood? Okay, I'll call my students' names. Mr. Hussaini, is it clear?
Sir, yeah, I try to understand some, but the line has been on and off. Although I understand what we are doing since we started. Only please let me use these opportunities to solicit for the this calculation after the lesson. You'll be sending it, because sometimes if you check all this calculation that you do, you can use it for reference. We don't see it here. We can't find it there. So you help us, sir. Thank you.
So if I understand what you're saying even when you go to watch the recorded versions, you don't see the calculations I'm doing.
Sometimes we will see it, but I think that if it is on working page.
Okay.
Yes, sir.
Now the challenge for that is the fact that you already have the solutions. I'm just walking you through the solutions.
Okay.
I'm walking you through the solutions.
Yes,
so if we were to solve a question that is totally outside of this, you probably would have been told ahead of the class, and you probably have it printed by your side. So as I'm solving, you have the question in front of you. But this, we are looking at the question to make the class fast and for us to be able to, complete the syllabus on time, is why we intentionally added the solution. If it was a physical class, the notes we use for the physical class, there's no solution there. I will have to walk you through from the beginning to the end. But if we have to do that for online, it may take some time. It's not impossible, but you will need to have the question by your side. For me as well, I will need to have the question by my side, maybe on another device and all of that. So that has been the challenge.
Okay.
But let me hear from other people. Do we understand? Ibukun Lutade, do you understand what we have done so far?
Yes, I understand.
Thank you. I cannot do without calling Mercy. Mercy, do you understand? I'm not sure Mercy is in class. All right, she is. Ogenetega, do you understand? Don't mind me always calling your names.
So,
I didn't get that. Your line was breaking. The line was breaking. I didn't get that.
Yes, sir.
All right, good. Now, let's move on. Let's move on to the next question. So please, let me just quickly summarize. What have we done here? Not done too much. I've simply looked at a scenario where control is retained. What is the implication of that? I will continue to consolidate. Bear in mind, what must I do in adjustment? Most times they ask you to show the separate position and they ask you to show the position of the group, the consolidated position. What you do is calculate the gain or loss on disposal. Remember, from the perspective of the parent in their separate book, they have no consideration for NCI. They will simply say, how much have I received? What is the book value of what I have just disposed? They compare the two, they get their gain on disposal, they move on. But when they come to consolidation, they will say, this NCI, what is the value of the increase in NCI? They will compare that to the amount we have received for that disposal. So when we are looking at the NCI, we now say, okay, for us to calculate the value of NCI, we simply say the net asset. How much is the net asset of the subsidiary? Then how much increase in holdings have NCI come to take? In the case of the question resolved, it was 30%. And that was why we did 30% times 200,000, which is the net asset. And that is how we get the gain or loss on disposal by comparing 30% of 260,000 versus the 140,000 that was paid, the consideration received. And that way, we came down to the gain or loss on, what is it called? The gain or loss on disposal. And that will lead us into consolidated retained earnings. Most of your adjustments that you have done will come up and show in your consolidated retained earnings. So you have to be careful there when we get to those type of questions where more elements will come in. Okay.
Sorry, we had a gain or loss on disposal of 116 earlier. 116.
Yes.
Okay, so what was that figure speaking to, please?
Separate book. You understand? In the book of Kako, you will see that.
Okay.
So what we did when we were doing separate book for Kako, we said this 280 plus the 116. And then we got 396. Okay. Let me show you that in the solution. So that's it on the solution. All right. That's the one, 396. Okay. You get it now? So it will be like this in the separate book of Kako. But when you are doing group gain on disposal, you will not calculate it that way.
Okay.
And what's the difference really? Okay. The difference is simply how you calculated that 30% in the separate book of the parent and how you are calculating it in the consolidated statement. What's the difference there? I did 30% of the book value of investments in Rice School, which was 80,000. When I wanted to calculate separate financial position of the parent. This is because what tells you what is the relationship between Kako and Rice School is this line. Do you understand? In the separate book of Kako, the only thing that is showing me that they have any relationship is that investment in Rice School. The carrying amount is 80,000. Now they have sold 30% of it. What they sold is worth 24,000. Simple. I'll compare this for 24,000 to the 140,000 you receive. That is for the separate book. But when it comes to the consideration for group, we'll say, oh, they paid for 30% of the net assets of NCI. This is what they paid for. So instead of saying 80,000, what I will be saying is, what is the net asset of NCI? Do you get my point? And net asset of NCI would be, what is the ordinary share capital as at the day of the transaction? It was, I think, if I recall, 80,000 thereabout. And then retained earnings as of the day of that transaction was 120,000. This is the net asset of the subsidiary. So the 30% I'm calculating here is against 200,000, not 80,000.
Not 80,000.
Do you get now?
Yes. Yes.
All right, good. So let's move on. I just hope we are all following. I don't want us to miss anything. Just pay attention to what we are doing. If you ever get confused with anything, let me know so that we can go back and look at it together. All right. Let's look at problem 2.1. The problem we want to look at now is the problem of what if control is lost? What if control is lost? What if control is lost? What if the parent sold so much that they lost control? So we'll look at problem 2.1. In problem 2.1, they sold 60%, meaning they retain only 40%. Okay. We'll look at problem 2.2 as well. Okay, problem 3. I thought when I saw 2.1, I will see 2.2. Problem 3. For problem 3, oh, good. We are going to see various type of situations. Okay, let's go back to 2.1. I thought I was going to see a 2.2. I didn't know it's just 2.1. All right. We may need to do some correction here. If you are looking at Rice School, you will see that there's the numbers jumped. Okay. This is supposed to be 50, so that everything here is 250. All right. So I think this moved up a bit. Is it clear, everybody? Do you understand what I'm saying? If you look at this may be confusing you somehow. Yes, so I'm trying to tell you current liability is still 50,000, just like the earlier case that we solved. All right. Let's look at the problem. We're told CACO acquired all the voting share capital of Rice Co. since incorporation of Rice Co. on 1st January 2015 for 80,000 naira. All right. We're told the statement of financial position of CACO and Rice Co. at 31st December 2017 as follows. Okay. Can see there investment in Rice Co. Like I said, in the separate book of the parent, this is what is establishing that relationship with Rice Co. All right, let's move on. Next paragraph. We're told it is the group's policy to value NCI at its proportionate share of the fair value of the subsidiary's identifiable net assets. All of that English is to tell you that when you want to measure NCI, simply say, what is NCI's holding? Whatever percentage it is, multiply it by the net assets that you are going to calculate for Rice Co. All right, easy. On 31st December 2017, CACO sold 60% of its shareholding in Rice Co. for an amount 220,000 naira. Beautiful. The fair value of the 40% holding retained was 100,000. Fair enough, they already told you what is the fair value of the 40% that was retained. Okay, now the very simple situation here. Okay, let me read the requirement first of all before I go on. The requirement asked us to prepare the separate and consolidated statement of financial position of CACO at 31st December 2017. All right. I have taught you how you are going to calculate gain or loss or disposal for the separate entity. So I want somebody from the class to quickly walk us through how you are going to do that. It's very easy, it's very straightforward. In the book of CACO, in the separate book of CACO, what is the amount that will be recognized as gain on disposal? I want somebody to walk us through it. How are you going to derive it? Okay, I have somebody who has unmuted already. You can go ahead.
That would be the fair value of the consideration received. That's the 220,000.
Okay.
Minus 60% of 80,000. That will give you the gain on disposal for the separate financial account.
How much do you get when you do that? 220 minus 48.
That's 172,000.
Thank you very much, Tintin. Tintin, right?
Yes,
Am I correct?
Sir. Yes, sir.
Thank you. Thank you. Is it a nickname?
No, sir.
All right, thank you very much. Do we all get what she said? It's as straightforward as anything. For the CACO, they are not doing anything extra. They're not doing too much. They're only saying, okay, all that we own in rice school, this is the representation of it, this 80,000. So if somebody, an investor has approached us and they paid for 60% of our holdings in rice school, they paid an amount They paid an amount 220,000 naira. Meanwhile, the carrying value of our investment in rice school is 80,000 naira. They have only paid for 60% of it. 60% of 80,000 is 48,000. Deduct that from 220,000. What you have left is 172,000 naira. Now, this will be the gain on disposal in the separate book. Sorry, please. All right, can you still hear me? A call came in from my, I hope we are still together. Let me know if you can still hear me, please.
Yes,
Okay, I just thought of something. Before we move on, I want somebody else, we've calculated that amount now. We've calculated that gain on disposal. It was an amount 172, if I remember. Yes, I think it was 172 we calculated. 172,000. So what I want to ask is this. What is the accounting treatment in the book of CACO? What is the accounting treatment in the separate book of CACO? What is the accounting treatment in the separate book of CACO? Anybody? Anybody? Anybody apart from Tintin? She has helped us with the gain on disposal. Somebody else help us with the accounting treatment. It's straightforward. We've discussed it before.
Hello, sir.
I'm with you, sir.
Okay. The accounting trade, let me just help. At least investment in rice will be credited with 48,000.
Good.
And gain on disposal also will be credited with 172. And the bank will be debited with 220. Bank will be debited with 220. That's increased with reduced with 220.
Increase. You increase
with 220. With 220.
Thank you very much, Mr. Uzeni. That was perfect. Exactly how we said it was going to go. So your gain on disposal will show in the retained earnings of CACO when you'll be preparing the separate financial position of CACO. With that, you have solved the separate financial position of CACO. It's as simple as that. You know, the requirement is in twofold. Do the separate and then do the consolidated. All right, very good. Now, in this regard, in this situation, don't you forget something very essential. In principle, you must remember that 60% holdings have been sold. What is, I'm going to the group position now, out of 100, we have sold 60%.
Okay, shit.
What we are left with is simply 40%. This 40% is below, this 40% is below 50%, meaning that CACO has now lost control. All right? CACO has done what? They have lost control. Now, if CACO has lost control in RISCO, when I want to calculate the gain or loss on disposal from the group perspective, I will calculate it as having it in mind that these guys, as much as they are in the group, they are no longer what? Controlling, meaning that consolidation will end that day. To be the last consolidation they are going to do. Let's look at it together, how that is going to be dealt with. We're going to do fair value of the consideration that was received. How much? 220,000. Receipt was 220,000. But this is only accounting for 60%. Okay? The remaining 40% that they have retained, I'm going to ask a question when I'm done with this. The question is going to be a little bit technical. If you can answer it correctly, I will know that my job is done. All right. Okay. Now, net assets that was acquired, that was disposed, net assets disposed at the date of disposal. Ordinary share capital was 80,000. Retained earnings as of that day was 120,000, according to the, what is it called? to the financial position we were given. This is group profits on disposal. Now, I want somebody to answer this very simple question. Why do you think we have brought in the fair value of the retained investments? Why do you think we have brought into this calculation when we wanted to do profit on disposal for the group? Why do you think we brought in the fair value of the retained investments? Why do you think we do so? Anybody? Or what do you think? What do you think is the difference between how we have calculated group profit on disposal here and how we did it when control was retained? Anybody want to try? Anybody wants to try? I have how many people in class today? I have 13. This class, are we not more than 13? I thought we were more than 13. No. All right. Anybody wants to try? Tintin, you want to try?
So I don't really understand the question.
Okay. Oh yeah, let me take you back. Look at the last question we solved. Look at the last question we solved. Yeah. If you look at how we considered profit or loss on disposal, we said fair value of consideration received versus increase in NCI, right? And how did we calculate increase in NCI? We said, how much did NCI buy of the net asset as of the day of disposal, right? So we did 140 minus 30% of 200,000, right? But look at what we have done here. Instead of doing it that way, what we said was what we have done here is to say fair value of the consideration received. Then we now added fair value of investment retained. All right. Now we are comparing that against the net asset of the subsidiary. Why do you think we are doing that? Anybody in this class want to try? I just wanted to try anyway. I'm not saying you have to say the correct answer. Praise. I've not heard Praise voice in this class. Praise Koyejo. Are you with us? Are you for us or you are against us?
For you, sir. Good evening, sir.
You're welcome. Do you have any idea or any contribution you want to make with regards to the question I just asked?
The difference was the fair value retained that was added.
Okay.
You're asking for the reason why it was added.
Yes.
Can't really say. Thinking because they don't have control again. So
on your way. Go on.
We won't be able to consolidate them. So in getting the gain, the group gain, we just recognize it so that we've treated it somewhere.
Sincerely speaking, you're not far from the end. You're almost there. You have said it. The whole idea is this: these guys are exiting the group. not exiting like exiting in terms of controlling the group, right? So when you are consolidating, even if you have 60%, even if what you have is 70%, you will consolidate as though you owned 100%. You will take NCI in, you will take everybody in, and you will do it that way. Abi? So the day you lose control as well, when you have to calculate your profit or loss, you will do it as though you have sold everything still. I don't know if you get what I'm saying. Look at what I did here. I was using style to point to you. Here I said 60%. Abi, sorry. I said 60%, yeah? The fair value of what they received was for 60%. The fair value of what is retained is for how much? 40%. So you are doing 100% versus 100%. Initially, when they retained control, you were doing, in that question we did 30% of the consideration they received versus 30% of the net asset of the subsidiary. But this time around, because they lost control, we are saying 100% versus the 100%. Is it clear? Is it clear? Is it clear? This is how you are going to remember how you do. Because if you go by, oh, what am I? You want to cram it. If you are trying to cram that adjustment, you may not get it too. But if you go by this logic that if control has been lost, then I am not going to do fair value of the receipt alone. I am also going to add fair value of what is retained. Then I will compare that against the 100% of the net assets that we are disposing of 100% of the net assets of the subsidiary as of that day. We may not be disposing 100%, but we'll do 100 versus 100 in calculating group profit on disposal. I want to believe it is clear from here forward. All right. So when we get to consolidated retained earnings, the group retained earnings as of that day, you will still consolidate as of that day, but going forward, you and I know that they will not consolidate anything again. They are not going to consolidate it. The only thing they are able to consolidate, the reason we are calling consolidated is because we are still going to take some profits as of that day. And let's look at it. Let's look at it. The same scenario as earlier. All the 120,000 naira will be regarded as pre-acquisition retained earnings. So as of the day of the disposal, 31/12/2017, all of those 120,000 naira that is in the book of RISCO will go to CACO because they used to own 100% of it. But don't forget, you cannot do NCI. It's not possible. You cannot do NCI. From the position of CACO, they cannot do NCI because they no longer have controlling interests. And now this is a lot easier when we come to the, what is it called now? To both the separate and the consolidated statement. It's easier. So that day, the only thing is this. When I say CACO and I say group, from the perspective of CACO, they will now do a group. That group they're asking you to do, just say, yeah, RISCO, investments in RISCO, investments. In RISCO, how much have they lost? They lost 48, Abi. So 80 minus 48. How much is that?
32.
32. I almost wrote 24.
32.
32. Sorry. They have 32,000. All right. Now the current assets. The current assets. Don't forget they received money. All right. They received money. They received 220,000. I cannot consolidate this 250. All right. I cannot do what? I cannot consolidate the 250. So even here, it is still 720. Yeah, what we have left in our books is 32,000 according to the separate book of Kaku. All right. But the fair value of what is retained according to the question is how much? 100,000. So I'll close this off. This is 752,000. This is 820,000. Let me erase this. Okay. Ordinary share capital is 200,000 here. It is still 200,000 here. Now, our retained earnings. Retained earnings, 280 here. We're going to add, what are we adding now? How much do you calculate the last time? We calculated, we must have done 220 minus 48. I think we had 172. So 280 plus 172. That should give us 452,000. All right. On this end, we're going to add up group. When we did for group, let me check. I can't remember again. Okay, 120. We had 120. All right. We had 120. We would also have taken up, let me just look at what we did under the retained earnings for group position. The retained earnings for group position, we did 520 rather. Okay. So 520 here. And then we were told current liabilities. Okay, before I do that, this is 720,000. This is 652,000. They have current liabilities 100,000. Yeah, 100,000. Yeah, I've told you you can't consolidate. The only thing that you must pay attention to, they have given you fair value of the investment retained. Don't forget that. And then in exiting the group as parents, we calculated some adjustment under retained earnings. These are the only two things that are likely to be different. And here we have 820,000 naira.
So please, how did you get the 520?
Okay. Oh, you must have forgotten that we did group retained earnings. Let me take you back there. Group retained earnings. What we did here, let me do it by the left. What we did here, if you recall, was to say, all right, in the book of CACO, retained earnings, CACO, RISCO, as per the question, or as at 31st December 2017, CACO had 280,000 naira as retained earnings. RISCO had 120,000 naira as retained earnings. All right. And then I now said that because group share. Can you please unmute? I said unmute. Can you please mute? So I said, since all of RISCO's retained earnings used to be owned by CACO, as at the day of disposal, they will take all of this 120,000, number one. And then number two is that from the perspective of the group, they have a gain on disposal. And that was how much? It was 120,000 as well. So this is how we got 520. Is it clear?
Yes, sir. Thank you.
All right, good. All right, good. Do we have any questions around this? Very important. You must pay, just let me go back again. You must pay attention to the fact that, do we still have control or we no longer have control? If we have control, if we still have control, I am only going to bother myself as regards what we have received by disposing to NCI versus what is the asset value of that increase in NCI. Depending on how I'm supposed to measure NCI anyway, you never forget that. But when I'm dealing with a scenario where we have lost control, is that same principle I was doing before. This whole time we have 70% and we'll consolidate notwithstanding. The only thing we will do is we will show NCI as a separate line of equity components. All right? But we'll take everything, we'll add up everything, even though we only own 70 or 80%. It's that same psychology I'm going to use now. Here we have retained investment, but we have gone from parent. We are now the NCI now. So in mind, that last thing I'm going to do that I will call consolidation is not really a consolidation, because the only thing that I'm showing in that consolidation is all that I have now received from the subsidiary and then the fair value of my retained investment. Every other thing is very much more or less the same. And that is what you saw exactly that we have done. Okay. If this is clear, I'm ready to push on. I'm going to go to problem 3. Now, I don't know if we'll be able to do all of problem 3, but let's begin. Let's begin. Problem 3 is a little bit more, not much more, just a little bit more complex than this. You have 1 or 2 adjustments. Other than that, it's not so hard. if you have understood what we have done with problem 1 and problem 2.1, I want to believe that we should have no problem here. Let's get started. Don't forget that we are only building blocks. So in building blocks, you must not forget all that you have learned. All that you learned in FR, very much relevant. All that we have learned in this class is still very much relevant up until this stage. Even when we get to foreign subsidiary next week, that's what we are going to focus on next week. Everything, you must carry on that knowledge. But in carrying on the knowledge, I don't believe in cramming. I believe what helps you is understanding and then practice, practice, practice. When you do that, if they set group, you'll be smiling to the bank. Not really smiling to the bank, you'll be smiling back home. You'll be happy that, oh, thank God. I think when I wrote mine, they said group, consolidation, and it was foreign subsidiary. And I remember I was so happy that day. I said, thank God. Thank God. I was so happy because immediately after that, what did you say? What did you say? I didn't hear you. All right. So immediately after that one, I knew the next thing I had to face were standards all through. Okay, standard of regulatory questions. I knew that was all I had to face after that. And that was how I passed. I passed with even very good scores because of that. Okay, just be rest assured. By the time we are done, we would have covered all of group aspects. And then what will be left is, after we have solved questions, past questions, is for you to go and practice. And I want to believe if the test group, you should be happy. All right, problem 3. We're told Resco acquired 80% of the share capital of Maxco for how much? For 162,000 naira. On which date? On 1st January 2015. At that date, Maxco's retained earnings balance stood at 90,000 naira. The statement of financial position at 30th September 2017 and the statement of profit or loss to that date are given below. You see, I've been given statement of financial position. They have also been given what looks like an extract of the POL of the two companies. Next paragraph. We are told it is the group's policy to value NCI at its proportionate share of the fair value of the subsidiaries' identifiable net assets. We are told to ignore taxation. Now, let me quickly chip that in. Anytime there is a gain on disposal, you get, whenever there is a gain on disposal, there should be a taxation element. Government of your country will say, oh boy, yeah, congratulations on your disposal. We're happy for you. But then you have to pay tax on this. Now, depending from country to country, it will be different rates. But this question has been so nice. They said, don't worry about taxation. They did not even give us any taxation rates. So we go ahead. What is the requirement? The requirement says we should prepare consolidated statement of financial position and statement of POL at 30th September 2017 in each of the following circumstances. A, Resco sold its entire holdings in Maxco for 325,000 naira on 31st September 2017. B, Resco sells 25% of its holding in Maxco for 80,000 naira. But pay attention to the date. 30th June 2017. Meaning, we are not going to rush through everything. You must understand that the day they sold is not the day of consolidation. Be careful whenever this is the case. Resco sells 50% of his holding in Masco for 170,000 naira on 30th June 2017. And the remaining holding has a fair value of 125,000 naira, and it should be treated as an associate. Some question will tell you it should not be treated as an associate. This one they told us. Now, if they did not tell you that it should be treated as an associate, if it falls within the range of associate, you carry on with the assumption that it is an associate. So, if they have not told you otherwise, if the holding is within 20 to less than 50%, what do you do? If they have not mentioned, you still go ahead and treat as an associate. We're told also Resco sells 50% of its holdings in Masco for 170,000 naira on 30th June 2017, and the remaining holding has a fair value of 125,000, and it should be treated as an investment in equity instruments. Okay. Lastly, we are told Resco sells its entire holdings in Masco for 325,000 naira on 31st, it should be 30th September 2017 now. This is the same thing as A, if I am correct. I think A and E, they are the same thing. Okay, let's look at A. Let's look at A. I'm quite pressed. Maybe in the next class, we'll look at B, C, D, E. We'll look at B, C, D, E. Or we look at A and B. I give you C, D as a C, D. There's no E. Give you C, D as assignment, possibly. Just go on your own, go and work it out. Okay, let's focus on A first of all. Let's see where that takes us. We are told they sold 100%. They sold everything. They have not just lost control, they have lost any retainer, there's no retainment of any holdings at all. Sorry. There's no retainment of any equity holdings in Masco. All right. Still simple to do. They did not ask us to do separate here now, Abi. I don't think they asked us to do separate. We are not doing anything separate. We're just going to focus. All right. Now, again, let me go back before. Remember that the requirement here did not say do statement of financial position alone. It went ahead to say you should also do consolidated statement of profit or loss. All right. Okay, so we're going to focus on consolidation, even though we know that there is nothing. There is nothing. Okay. How do we go about this? 100% has been sold. Consideration received was 300 and FV of consideration received was 325,000. Is there anything retained? Retained is 0. This alone on its own is 100%. But wait. Let me be careful. Okay, they acquired 80%. All right. No wala. Okay. Sorry. I need to be calm. All right. This is not a simple, this is not as simple as what we've been doing since. Why? Resco acquired 80% of the shares of Masco. They paid 162,000. And the date they acquired, we were given. They didn't tell us that they have always owned Masco from incorporation. They told us a particular day. So chances are that they paid an amount that is greater than the net asset that was acquired on that day. So therefore, we need to first of all see if there is a goodwill. Remember that we're going to cancel out 100%. So let's know, was there a goodwill at the date of acquisition? Okay, I can say at date of acquisition, the same thing we have always done right from time. Fair value of consideration that was paid on the date of acquisition. That means we are going back to 2015 now. Don't worry, we'll still come back home to 2017. But let's start with 2015. That day, they paid 162,000 naira. This is only accounting for 80%. So where's the remaining 20%? It's NCI. How should I measure NCI? I was told to measure NCI at proportionate share value, fair value rather, of subsidiaries' identifiable net assets. So before I can do what I can get to what NCI is, I need to first of all calculate what is the net asset that was acquired on that day. All right. Ordinary share capital is how much? As of, they didn't tell me it changed. So I'm going to assume as of that day, Masco had 90,000. All right, ordinary share capital. Where did I pick this from? I picked it from the statement of financial position as of September 30, 2017. They didn't tell me anything about any movement on ordinary share capital. So I will assume, even as at 2015, it was still 90,000. However, I cannot pick the retained earnings here. I have to pick the retained earnings as of the day of acquisition. So retained earnings on the day of acquisition was 90,000, meaning the net assets that was acquired was worth 180,000 naira. A typical exam question would have told you blah, 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 blah about maybe brand name or maybe about some other fair value adjustment. But in this question, they didn't give us anything like that. So I would just say 20% of 180,000. That should give me 90,000. We have now measured NCI, the remaining 20% at 90,000. Okay. If I add these two together, I get 252,000. All right. So what is 252,000 minus 180,000? Oh, sorry. Somebody help me calculate 20% of 180.
36,000.
I did 50%. Sorry, I just looked at it now. 36,000. So this should be 198,000. So our goodwill is quite easy. Is how much? 18,000. Now, what is the significance of this? Why is this important? If I go ahead and go and calculate gain on disposal, I will be calculating what we have received versus 100%. But part of that 100%, there is a goodwill of 18,000. If I omit it, I would have made a terrible error. Okay? Let's see that so that I can understand what I'm saying. You see? When we come here to calculate this, I have told you when control is lost, I'm doing 100% versus 100%. What do I mean by that? At the date of disposal, I am going to calculate the net asset. I am going to calculate the net asset. But I'm not doing the net asset alone of the subsidiary. I'm doing the net asset of everything that I am disposing. I had a goodwill, and they have not told me that that goodwill was fully impaired. So therefore, I should calculate that goodwill as, unlike the other question, they owned that one from inception. So there was no goodwill. All right. Okay. So what we own only represents 80%. All right. Now we are taking away our 80% and we have received the value for it. How much did we receive? We received 325,000 and we have nothing retained. Sorry. What's the attention we must pay here is that we sold off 80,000, 80%, and we have nothing retained. So in my solution here, I don't have all the 100%. I only used to have 80%. So I'll say FV, sorry, what's this? Apologies. I'll say FV of the consideration that we received. Consideration received was 325,000. All right. Now, the ordinary share capital we have is 90. Retained earnings as of that day, all of it was 180,000. Goodwill, which we have just calculated, is 18. Now, we have NCI in the books. We have NCI in the book. Take away that NCI. NCI will no longer be 36,000 here. In calculating the NCI, I am going to say, what is the net assets as of that day? The net asset as of that day is 90 plus 180. Are we together? 90 plus 180, making 270. So NCI only owns NCI only owns 20% of 270. All right, I'll take that away. What I am left with is the representation of all of these 80% that we are disposing. What do we have as the gain on disposal? The gain of disposal as of this day is going to be how much? 91,000. Okay. 91,000. Now, this gain on disposal, I am also going to recognize this adjustment when I am dealing with consolidated retained earnings. So when I get to consolidated retained earnings, I'm going to say, what is the retained earnings Sorry. Let me do this somewhere separate. I think we already got this one for good. Let me do it somewhere separate. I'll say as of 30th September 2017, what is inside RESCO? What is inside MASCO? Retained earnings for what is it called? MASCO, they said is 180. What is it for REXCO? Let me just move to where we have the solution. All right, it was 270. It was 270 there. And then I'll say 270 here. All right. What was the gain on disposal? I said you take that gain on disposal into this adjustment. Gain on disposal was 91. Now, don't forget that RESCO only has 80%, not 100% like the other case. 80% of 180. Oh, sorry. As of the date that we acquired MASCO, as of the day that we acquired MASCO, they already had 90 in their books. It is the post-acquisition we are trying to share. Therefore, we are taking 80% of that 90, and that gives us 72. If you add these together, I said 270 is 207. You get 370. All right. So this 370 is what we are taking in as our consolidated retained earnings. Let's deal with financial position first. So when I come here and I want to treat, I have a low battery, sorry. When I come here and I want to treat this consolidated retained earnings, I have no right to this 135,000 PPE. So I'm picking my 180. Investment in MASCO, there's nothing like that again. And there's no fair value of investment retained, all right? Now, should that be the case? Nothing is here. But for current assets, I have this 185 before. I have just received 325,000 naira more. 185 plus 325,000. That should give me 510. So everything I have here is 690. When I come to ordinary share capital, I will still have this 270 here. We have calculated the retained earnings. The group retained earnings we calculated just now, I can't remember again. Calculated it just now was 370. 370. So I come back here and say 370 consolidated retained earnings, and this will give me 640. I am not also going to consolidate current liabilities, so I'm taking only the 50 that belongs to REXCO. And that is how I will show. So the only thing we've done, what we are exiting with, is this consolidated retained earnings, the group retained earnings, as of 30th September 2017. That is all. That is all. Now, this is very straightforward, I want to believe. But what you must pay attention to is when they say consolidated statement of profit or loss. You must be careful. You must be careful. You know why? You must understand that all of the profit till that day would have accrued, I mean, 80% of it would have accrued to Elexco. They will still share in it because as of those days, they have not yet disposed. So for that year, running till 30th September 2017, which I want to believe is their accounting date, they are going to get all the profits, 80% of all the profits till that day. Okay? And I'm sure that is what was done here. I'm sure that is what was done here. Let's look at it. They even made an explanation. Let's go to the explanation. We're told, pay attention to this. We're told from this timeline, Rex had 80%, meaning that from October 1st, 2016, we count back 1 year. That's why I said I want to believe this is the accounting period, accounting year end. So we go back from the start. From that day till this 30th September 17, they are still going to be getting 80%. They are still going to be getting 80% of the holding, and you will have to consolidate. Why? Because throughout this entire period, they had greater than 50% equity interest. Okay, so we are still going to go ahead and consolidate around it. All right. So you will see how POL was treated. When they got to POL, they were still getting 80% of, they got 80% of the profit before what is it called now? Before tax. They still shared in the tax. The only thing that is different is that they have a group profit on disposal that came in, and the rest is history. All right. Okay. My phone device is suffering from giving internet to the laptop. I'm having a low battery. Let me just know, do we have any challenge around this? Some people have left already. I think people want to go and sleep. But let me end it here. I will draw the curtain here. Do we have anything around this that you want me to touch light on? Any area of it? We'll come in the next class, we'll go into the rest. But for this one that we've done, is there any area you want me to go back to?